Hello, good morning, everybody, or good afternoon, depending on where you are. My name is Nick Kuznets, and I'm a reporter with Inside Climate News, where I cover oil and gas. And I'd like to welcome you to this panel today, where we're going to talk about the Conference of the Parties, or the COP Summit, and what the U.S. role will be and what to expect out of it. We've got a great group of panelists to cover this. I think just to sort of set the stage, it goes without saying that there's been a total about face in the US on the Paris Agreement and climate change. You know, we've gone from an administration that had pulled the country out of the agreement to one that's not only engaged in it, but is trying to raise global ambition. The Biden administration has also talked a lot about an all-of-government approach to climate change. So embedding climate into everything from foreign policy to financial policy. And another aspect that the administration has really talked a lot about is the role of markets and the importance of markets in addressing climate change. And what is the role of government in regulating markets, in sending the right signals to markets. All of these, I think, are things that are relevant to the upcoming COP and that I think we'll touch on today. So without further ado, I'd like to introduce our panelists. We have Susan Biniaz, who is a former deputy legal advisor at the US Department of State, where she handled a wide range of international law issues. From 1989 until early 2017, she was a lead climate lawyer, including for the negotiation of the UN Framework Convention on Climate Change, the Kyoto Protocol, the Copenhagen Accord and Cancun agreements, and the Paris Agreement. After leaving the US government, she was a senior fellow at the United Nations Foundation and taught various international law courses at Columbia, Yale, and the University of Chicago. She recently returned to the State Department to support Special Presidential Envoy on Climate, John Kerry, on international climate negotiations. She's also a senior fellow and lecturer at the Yale-Jackson Institute for Global Affairs. Next, we'll hear from Samantha Ross. Sam was one of the founding staff of the Public Company Accounting Oversight Board and helped build it from the ground up for its first 15 years. She contributed to the building the world's largest and most respected audit oversight institution and achieving long-term positive incremental change to make audits more transparent and relevant to investors. She helped the board develop many new auditing standards, including on auditor independence, the auditor's reporting model, and internal control. Sam founded Assurance Mark to continue to serve investors' interest in high quality, reliable reporting and assurance on important disclosures in and beyond the financial statements, including climate disclosure. And finally, we'll hear from Robert Schuerk, who is Executive Director of Carbon Tracker's North American office. Rob leads Carbon Tracker's outreach and data provisions to the Climate Action 100+ initiative, as well as its work with securities market regulators and accounting standard setters around the globe. He's authored several papers on how climate-related risks are likely to impact financial reporting and the role that securities market regulators can play. Prior to joining Carbon Tracker in 2014, Rob was an assistant attorney general with the New York State, and prior to that, a litigator in the New York City offices of Paul, Weiss, Rifkin, Wharton, and Garrison. So first we're going to hear from Susan. So take it away.
Thanks a lot, Nick. I thought I'd give a little background on the Biden administration's policy on international climate issues and try to weave in COP26 into that context. So taking a whole bunch of international climate objectives, I'm going to group them into basically 3 clusters because I think it's easier to think about them in that way. The first cluster I think of as getting the US on track or back on track. The second would be exercising US climate leadership. And the third would be raising global climate ambition. And there's obviously overlap among those, right? Because the more the US can get back on track, the more credibility it has and the more able it is to exercise leadership and raise ambition, et cetera, et cetera. Okay, so taking the first cluster first, getting the US back on track, you could think of this also as just getting the US House in order. It has several components. The first and foremost was getting back into the Paris Agreement. As you mentioned, that was a day one priority. The instrument was signed and the US became a party 30 days later on February 19th. Another very early task was, the requirement under the Paris Agreement for each party to have in place a nationally determined contribution, or NDC. Very early climate executive order tasked the executive branch with coming up with the next US NDC for the year 2030. And that was announced recently, and it's going to be a 50 to 52% reduction below 2005 levels in 2030. The third piece was also in that early executive order, directed agencies to come up with a climate finance plan, and that was delivered also a couple weeks ago. And a fourth piece was, for those of you familiar with the Kigali Amendment to the Montreal Protocol on the phase down of HFCs, there was a direction in that same famous executive order to the State Department to come up with the package that would then be sent to the Senate to try to get Senate approval to join the Kigali Amendment. And that package is done and is now at the White House. So I think I would give us an A in terms of getting the US back on track. Obviously, implementation needs to be done with respect to each one of those, sometimes in terms of congressional action, sometimes in terms of Senate action, but at least whatever could be done by the executive branch, has been done. So the second cluster is leadership, and there you have the appointment of John Kerry as the first ever special presidential envoy on climate. We've had special envoys before, but the point was to raise the level, raise the profile, and show how important this issue is to the new administration. The second was a Biden campaign commitment to hold a summit on climate at the leader level, which is pretty unusual, within the first 100 days of the administration. And that took place on Earth Day. Maybe some of you followed it. It was also unusual in the sense that it was live streamed, which leader level events are usually closed door affairs, but it was virtual and everyone could watch it. 40 leaders were gathered. They included a reconvening of the Major Economies Forum from past administrations, which is essentially the emitters that add up to about 80% of global emissions, and then several other heads of state to bring various points of view to the table. Secretary Kerry held roundtables at the ministerial level below the leader level, and about 63 countries participated in that. There were lots of announcements above and beyond the US NDC announcement, and I think it's fair to say that it created quite a bit of momentum towards COP26 in Glasgow. The other point of leadership or other aspect is that same executive order I mentioned before basically instructed the executive branch, and this will mostly be carried out by the State Department, to raise climate change in bilateral engagement with other countries and in a very wide range of multilateral fora. Not just the typical ones where, the COP process, where obviously you're going to raise climate in a climate forum, but also to raise climate and try to integrate climate considerations into other issues. I think of it as like climate change plus X. So in the G7, in the G20, in the International Maritime Organization, International Civil Aviation Organization, the Arctic Council, ocean fora, every place where maybe to date there has not been as much action on climate, to kind of go in there and double down on it. So that's the second cluster. And then turning to the third, where we get more into the COP, is raising global ambition. So for those of you familiar with the Paris Agreement, one of the three objectives of Paris is to limit global temperature rise to well below 2 degrees centigrade. And there was language put in there at the time that was, insisted upon by small island states, but I would say it was not taken as seriously by most countries as the actual goal of the Paris Agreement. It said you should also pursue efforts to keep the temperature rise to 1.5 degrees centigrade. But what happened just maybe 2 years after Paris was the IPCC issued its so-called 1.5 report, and it was quite clear that the distinction between 2 degrees and 1.5 is very stark in terms of impacts on the world. So I think at this point, many countries and non-state actors are making the point that you really need to lean into 1.5 degrees rather than just 2 or well below 2. So that leads me to, what is the US's overarching goal for the COP? It's basically to make substantial progress toward keeping 1.5 within reach. We put it in different ways. Sometimes keep it within reach, on the table, in sight, not foreclosed. You'll hear different variations, but you get the point. There are lots of ways the world can make that kind of progress. It doesn't just take one form. One way is to get as many countries as possible to commit to net zero goals, hopefully by 2050. The US has articulated a commitment to reach net zero domestically no later than 2050. The UN Secretary General has also made net zero one of his cause célèbre. He I think, uses mid-century maybe to cast a wider net around countries that can't necessarily meet net zero by exactly 2050. Another form would be enhanced NDCs, 2030 NDCs. The US just put in its 2030 NDC, as I mentioned, but many other countries already had NDCs on the table, but they were from 2015. So the idea is they should be raising them to align them with 1.5 degrees and net zero goals. And there are many other actions that need to be taken, whether on a sectoral basis and whether by parties or non-state actors or multi-stakeholder initiatives. But all of those kind of need to be added up, and a gigantic ribbon needs to be, I think, wrapped around them at COP 26 to signify the increase in ambition. Now, I should note that ambition is not formally on the agenda of this COP. It's kind of a necessary component of the COP in order to make Paris work. But the things that are formally on the agenda are more about completing the so-called Rulebook under the Paris Agreement. These were the things that were supposed to be elaborated that were not finished in Paris. Most of them got done a couple years ago at the Katowice COP, but some of them are outstanding. One, of obvious interest to our audience is the so-called Article 6 guidance, which is all about market mechanisms, the new version of the Clean Development Mechanism, and the guidance for any kinds of transfers of offsets or emissions trading, focused most significantly on avoiding double counting. Other things as part of this rule book include finishing the transparency rules, where parties have to. It's a very important part of the Paris Agreement, because it's all about parties reporting on what their emissions are and how well they're doing in implementing their NDCs. So it's really important for the operationalization of the agreement. But in terms of importance, I would say completing the Paris Rulebook is necessary, but not sufficient. You could have a successful COP even if you didn't quite finish the Rulebook. You couldn't have a successful COP if you finished the Rulebook, but you didn't increase global ambition. So let me just end with a few words about why we think this COP is particularly important. So I'll give you a couple of reasons. One, it's important just for the kind of almost revival of the Paris Agreement. Paris has taken a couple pretty serious hits since 2015. First was the Trump administration's decision to withdraw. No one followed the lead of the Trump administration. Nobody actually withdrew from Paris, but it definitely had the effect of making some countries feel like they did not have to take too much action. They knew that they were not going to be, called out by the United States. The second hit was obviously COVID-19. The COP didn't even take place last year. It was delayed until this year. So it has kind of built up a bunch of pressure to make, this COP make up for lost time. So that's one reason. The second, I guess I would say, is maybe science. Ever since 2015, the pressure has been building to increase global action, because science keeps telling us that the scale and speed of action needs to increase beyond what we thought it used to be. And then third is that 2020 was supposed to be, a very significant year in terms of raising of ambition. And the reason was that in 2015, some countries took on 2025 targets. We were one of them. Most countries took on 2030 targets, and that was a full 15 years away, right? So the whole idea was we shouldn't just like do nothing between 2015 and 2030. We should have almost like a way station along the way, and that should be in 2020. And countries with 2025 targets should put in their next target. That makes sense. But countries with 2030 targets should be reconsidering them and either restating them if they wanted to stick to them, or hopefully updating them in light of increased ability to take action, increased scientific awareness, et cetera, et cetera. So 2020 was supposed to be the year when that happened, but because of COVID, there were obvious distractions. And so 2021 is kind of the new 2020, right? So this year is an important COP, not just because the rule book is completed, but it's kind of taking the place of what was supposed to happen in 2020. Many countries have increased their 2030 targets. Post-US summit, we're at the point where about 55% of the world's economy, the world's GDP, has taken on 2030 targets that align with keeping 1.5 degrees alive, but that's not true for all the major economies, and particularly not true for China, which has a carbon neutrality goal set for 2060-ish, but is not taking enough action in the 2020s to actually keep 1.5 alive. So, last point would just be it's important for the sake of for climate change itself, the credibility of the Paris Agreement, and sending the right signals to the marketplace that the parties step up their level of ambition at COP26. Thanks.
Great, thank you, Sue. And I should have said before that we'll hear from each of the panelists, and then we should have some time for questions. And there's a Q&A box that you can type questions into. And so please, along the way, add questions there, and then we'll get to as many as we can. So next, we'll hear from Samantha Ross.
Great, thanks so much, Nick. So I'm now going to turn to the private sector. I'll touch a little bit on the government, but the government's impact on the private sector more specifically, and focus predominantly on what US companies and investors have been doing. So until recently, the corporate disclosure about climate change has been really mixed. It's been predominantly voluntary. Back in 2010, the SEC issued some guidance on how climate change related to existing requirements under the Securities and Exchange Commission's rules on disclosure, but it was pretty light guidance. And then over the next many years, it was really not enforced very much. So you don't see a lot of climate change related information in company disclosures, other than very high level risk disclosures that just kind of mention it. So that's been a problem that investor groups have been working on outside of the context of the Securities and Exchange Commission for many years. And there have been a lot of different frameworks for disclosure that have been developed over the years that relate to climate and other environmental and social and governance topics. Probably the most famous of these initiatives is the Financial Stability Board's task force on climate-related financial disclosures, which came out with a set of 11 recommendations in 2017. Investors have, on the whole, been very supportive of those recommendations and have pressed companies to improve their disclosure and specifically use that framework. Since it's voluntary, it really hasn't gotten much uptake, though. There's been there's a lot of companies say that their disclosures are informed by the TCFD recommendations, but there's no real enforcement mechanism for it. So it has been, the disclosures have been a little bit on the thin side, and they tend to kind of focus on more the positive things the companies can say. Last fall, a group of 30 prominent economists, including co-chaired by Janet Yellen, who's now Treasury Secretary, came out with a report that encouraged companies to disclose under the TCFD recommendations. They said that based on their research over the last several years, only about, on average, companies that claim to disclose under the TCFD voluntarily usually only addressed 3.5 on average of the recommendations. So there was a large gap there, and for many years there was not, the actual government regulator over corporate disclosure, the Securities and Exchange Commission, really just kind of left it to companies and investors to negotiate privately on what kind of disclosure, public disclosure companies would make. So there really wasn't much that investors could do about it other than, try in their proxy votes, try in proxy proposals to press companies to do more. So all that changed quite dramatically this year when the administration changed, and a new acting chair of the SEC was appointed as soon as President Biden took office. That was acting chair Allison Herron-Lee, who was very much ready to go on enhancing climate-related corporate disclosure. So in February 24 of 2021, acting chair Lee came out with a press release saying she had directed the Division of Corporation Finance inside the SEC to enhance its focus on climate-related disclosure in public company filings. This was a major statement because the SEC had not been enforcing climate disclosures, pretty much ever. And so this was a big statement. A lot of, it was basically signaling that the SEC's existing principles-based disclosures really called for climate-related information that hasn't been provided, because it calls for risks, because it calls for, taking risks into account in valuation, and other types of in corporate accounting, in corporate other kinds of risk disclosures that companies make. So anyway, this was a major signal to companies, a huge wake-up call. Shortly thereafter, just a matter of days, the SEC came out with an announcement about its new exam priorities. So it conducts examinations of funds, investment advisors, and other kinds of entities, and said that in those exams, it would take a greater focus on climate-related risks. And specifically, it would look at how climate-related risks are taken into account in proxy voting policies and practices to ensure that investors and advisors are voting in alignment with the beneficiary's best interests and expectations. And of course, we all know there's been a lot of public expectation about like ESG investment funds, ESG mutual funds, climate-focused mutual funds. And when a fund has that kind of, marketing, the SEC is really looking for whether the fund is actually doing the same things that it's talking about in its marketing. Shortly thereafter, literally the next day, the SEC came out with an announcement that it was creating a climate and ESG task force in its division of enforcement. That's the division that conducts investigations and then makes recommendations to the commission about charging companies or individuals for violations of the securities laws, which can include violations of the laws about disclosure. And so again, another really big wake-up call. All of this happened in the matter of about a week and a half. So it really kind of shook up the corporate reporting community. And then finally on March 15, the SEC announced that it would embark on new rulemaking to require new climate disclosure. So it wouldn't just rely on enforcing existing requirements that are kind of principles based and apply them to climate, but would actually have real climate disclosure requirements. And at that time, the SEC sought public comment on what the shape and content and scope of those disclosures should be. We're in the middle of that comment period now. The comment period ends in June. And all the word coming out of the SEC today is that we can expect a proposal on new climate disclosures probably soon after the comment period closes. This is sort of in the nature of a concept release kind of comment period now, and we'll see an actual proposal perhaps as early as this summer or early fall. And then finally, I just wanted to mention, because I had talked about the SEC's exam priorities, to some extent, those priorities had been, even before the SEC announced it, they'd already been conducting exams in these areas. So on April 9, they were ready to issue an alert from their Division of Examinations on their review of ESG investing by funds and advisors. And they came out with a number of really big findings that I think are going to change practice in funds, that are already changing practice in funds and with advisors. And they were that they found that portfolio manager practices were inconsistent with disclosures that the funds were saying about their ESG approaches. The SEC also found that controls were inadequate to maintain, monitor, and update clients' ESG-related investing guidelines, mandates, and restrictions. They found that proxy voting has sometimes been inconsistent with advisors' stated approaches in their marketing. They also found that there were unsubstantiated or otherwise potentially misleading claims about funds' ESG approaches. They found that there were internal inadequate controls to ensure that ESG-related disclosures and marketing are consistent with the firm's own practices, and that the compliance programs did not adequately address relevant climate and ESG issues. So again, that was a big wake-up call, and it's already causing a lot of funds to change the way they operate and to improve their controls over, if they say that they're focusing the fund on reducing carbon emissions, for example, that they have some evidence to prove that they're really doing that. Of course, having better corporate disclosure will be extremely important for funds to be able to do that work that they've sought to do. Let me just touch briefly also on another area that's underneath the SEC, and that's accounting. There are two major accounting systems that are used in the United States. One is called the International Financial Reporting Standards. That's used by large non-US companies that file in the US. And in November of 2019, one of the members of the board that sets those standards, the International Accounting Standards Board, came out with a very comprehensive paper on how the international accounting standards apply to climate-related issues, and went through very carefully the various different standards that that companies should take into account when they're filing under international financial reporting standards. That was followed up a year later, so last fall, with some educational guidance that the entire board put out. So that was pretty momentous and helped companies see that they really needed to start showing the impact of climate change, the impact of the energy transition through their financial statements under existing accounting standards. But for all that time, the domestic US Financial Accounting Standards Board that sets standards that are followed by most US public companies, that group was completely silent on climate. So there was this strange idea that although the standards, frankly, are very similar in most respects, there are some really arcane ways that the two sets of standards are different. But for the most part on these big topics, they're exactly the same. But the international body had come out with a paper on how much climate wove through the standards, and the Financial Accounting Standards Board was silent. But on March 19, the Financial Accounting Standards Board finally came out with its own staff educational paper. It was much shorter. There wasn't a lot of fanfare to it, but it was very much consistent with what the international group had put out a year and a half earlier about how climate and other ESG topics related to accounting standards. So based on that, we hope to see more companies actually, with the SEC enforcing the rules, and then now FASB even saying that climate is already relevant to accounting. We hope to see much more information about the impact of climate-related financial risks in companies' financial statements. So let me turn to that's kind of on the SEC production and production of disclosure side. Let me turn to the other side, the people who get the information and the people who receive and what they do with it. So first of all, I'll start with banks. A number of banks have announced, based on pressure from their own shareholders and other sources, I think, have announced commitments to have their own pledges to move to net zero, sometimes just scope 1 and scope 2. And then lately, over the last few months, probably 4 or 5 months, we've seen a lot of the big banks move to broader net zero financed emissions commitments, meaning their scope 3 emissions that relate to companies that they give loans to or are invested in, which is of course much bigger way that they impact climate change. So HSBC, JP Morgan Chase, Bank of America, Wells Fargo, Goldman Sachs, Citibank, they've all come out with these net zero financed emissions by 2050 goals. In addition, a number of banks, more than 90, have gotten together and internationally and formed a partnership for carbon accounting financials. Over about a 1.5 year period, they developed a standard for how they would track their emissions, especially their scope 3 emissions that related to the different kinds of financial instruments that they were selling, and loans and investments and mortgages. Other credit facilities for companies. They had to come up with a system for how to attribute carbon emissions to the underwriting bank, and how to share them, whether to have overlap, double counting, how to deal with all that. So the Partnership for Carbon Accounting Financials, known as PCAF, the acronym, they came out with their standard on carbon accounting in November of 2020. So just a few months ago, but already, many banks, the banks that were already committed in that and participating in the project, and then many banks since then have also signed on to PCAF. So we should start, this is the first year, of course, but we should start seeing banks have that kind of reporting system that then will be made public, and banks' own shareholders too are going to be evaluating the bank's progress. The PCAF actually creates different categories of companies and phases in the measurement, but the major emitters like oil and gas industry, that the PCAF standard applies starting this year in 2021. I should also mention there have been a number of other initiatives of various kinds of intermediaries and entities in capital markets. The Net Zero Asset Managers Initiative, the Net Zero Asset Owner Alliance. Just this past April, a Net Zero Banking Alliance was formed. And all of these entities, which are were originally, each one of them was UN convened, but they are, the members are all the private sector entities in that classification that sign up to various net zero type commitments. All those entities also announced an umbrella organization called the Glasgow Financial Alliance for Net Zero to work on targets and commitments that they'll make in connection with the COP this fall. Other financial intermediaries, in December 2020, Lloyd's of London announced that Lloyd's Corporation and its members will end new insurance cover for oil sands and new Arctic energy exploration activities from January 1, 2022. In February of 2021, just a couple months ago, Standard & Poor's downgraded its credit ratings for the 3 oil majors. Those are just a couple of examples, but a number of other kinds of announcements like that are being made by credit rating agencies, insurance companies, and other kind of gatekeepers. In addition, on the investor side, we've seen a record number of shareholder proposals for enhanced climate disclosure this year, and a record high level of investor support for those proposals, including support by some of the major asset managers that had not been supporting some of these proposals in past, like, for example, BlackRock, State Street, Vanguard. So we're seeing the percentage of support for these proposals to be much, much higher. In fact, just last week, there was a shareholder proposal at General Electric to require, to suggest to they're all precatory or advisory, but the proposal basically was to ask General Electric to start tracking and come up with a plan to reduce its scope 3 emissions, and it got 98% approval by the shareholder base. That's just, an enormous number.
Sam, I'm sorry to interrupt, but I just want to make sure we have time for Q&A.
Sorry.
So
well, let me finish up right there. I think, I was pretty much done anyway, so that's great. We can talk about any kind of disclosure issues in the Q&A. Sorry.
Okay, perfect. Not to worry at all. So next we will hear from Rob.
Great, thanks, Nick. Yeah, so I just want to telescope out a little bit and think about some of the things that we've just talked about. So, there is sort of the formal COP, which is a lot of the work that's happening at the governmental level. But there's also the COP outside of the COP, if you've ever been there. And that's really, in some ways, an expression of a lot of the work that civil society is doing and a lot of work that Sam was talking about, that's really laying the groundwork for what is going to be possible, what we're really going to be able to do to back up some of the ambition that happens at the governmental level. So Special Envoy Secretary Kerry has made pretty clear that the 2020s are really the decade where we have to do everything we can to keep 1.5 in the frame. And if we don't do it, we're not going to be able to do it. So this is the time where we're really going to have to act. And it's very clear, I think, that we haven't done that. I mean, we had oddly some reprieve on this with the pandemic, but emissions are now going up as people go back to what they were doing before. And it's clear that there's a lot of structural changes that we're going to have to do. Some have said, even if we get to net zero by 2050, we're then going to be focused on how do we get some of this carbon dioxide out of the atmosphere. So it's very much a daunting challenge that really is kind of all hands on deck. And I think that when we think about the COP, we have to think about the interplay between what the government can do in its capacity in sort of leading and setting ambition, and what the government can do to facilitate changes in civil society to let private actors also pick up some of the slack. Obviously, the last 4 years have made it difficult in terms of U.S. credibility at the international level, or at least introduced some uncertainty about where the U.S. would stand as a country. That's notwithstanding despite the fact that there were many actors at the state and local levels that very much were still in the COP, even though the Trump administration pulled us out. But what that also showed was that there wasn't really a way to hold back the tide. When you look at how many coal jobs there were in the United States, there was about 280,000 jobs in the coal sector in 2012. By 2016, those had fallen to 50,000. And even though Trump promised to do a lot to help the coal sector, we ended up with 10,000 less jobs, so down to about 40,000 jobs by the end of his term. And what that really shows is that there are some large trends and economic trends that really are benefiting this transition. And you can see that in the cost of renewables. We did a study that showed 50% of the world's renewables potential is cheaper than fossils today. 90% probably will be a decade from now if you look at the learning rates. You look at the cost of capital. The cost of capital for coal mines, for oil pipelines, for oil refineries, it's about 50% more than it was in the decade of 2000 to 2010. So you can see that there's a lot of economic transformation that's underpinning what the ambition can be. And in fact, when Special Envoy Secretary Kerry announced U.S. Climate targets, which was an increase in the ambition from the Obama era, you saw that there were, what was I going to say? One of the reasons was the technological developments and other things that made that possible. As Sam touched on, there's a load of net zero ambition all across civil society, even to the point where there are companies, and one can challenge, I think, fairly the categorization of some of the climate targets as net zero. But the notion is that there are many oil and gas companies themselves that are very interested in saying or carrying the mantle of net zero. And I mean, I think if you were, a visitor from another planet that came here, and you saw we had a problem with emissions and you saw all this target setting, you would be quite confused, because you would say, how could it be possible that all of civil society and government are in favor of this thing and they can't get it done? At least not yet. So I think that right there is going to be one of the big challenges that we're going to see at the COP. And I think there's really it's important to think about two roles that government can play at the COP in order to facilitate, actually not just creating the ambition, but enforcing it. So there's the classic government role, which would be, let's set the goals, let's set the direction of travel. This is kind of what the UNFCCC target setting is in many ways. And the net zero 2050 goal, I'd say, is an invaluable thing of the many versions of a Paris goal that fell out of the Paris Agreement itself. Then there's milestones, implementation, and enforcement. Right. So now we have these goals. Well, what are we going to do to really enforce it? And I think, that's something that was not really central to the 2015 Paris Agreement, but clearly contemplated and important to address at an international level as well. And the third thing I'd say in the classic government role is building support. So this is kind of the bully pulpit role, you could say, in terms of leadership and bringing people along and articulating to them why it's actually in their advantage to work on this. But there's a set of civil society goals as well, and I would call this sort of the facilitating role of government, that where we can see, I think, a lot of things, and there's really a lot more potential now that the financial community is getting on board with the Paris targets and becoming very interested in how those are going to play out. And by facilitating, I mean not just the fundamental development and research like the sunshot, or frankly, even with the pandemic vaccines would be another example. So just funding that sort of basic fundamental research to bring down learning curves on technology, but also facilitating market structures. Those are things like the disclosure and the transparency rules, looking at the systemic impact of climate-related risks. And then finally, unburdening some of our regulatory regimes, for example, in the utility sector, so that we can really facilitate the onboarding of more renewables and more clean energy technologies. And I think it's important to think about those things and think about the all-government approach that countries like the United States are taking and how that can also be exported and shared. Because when we talk about COP, we're talking about international collaboration. That can also happen at other levels. So whatever the SEC does isn't just something that has to stay within the bounds of the United States, even though that's their remit. It can also apply to the international bodies like the International Organization of Securities Commissioners, IOSCO, where the SEC is a member, and it could be partaking and exchanging information, know-how, best practices, and other things with other countries, to really kind of help give that information to markets so markets can price in this transition risk and act accordingly. And I'll maybe stop there because I know we want to leave some time for questions.
Okay, great. Thanks, Rob. So again, everyone, there's this Q&A box that's down on the bottom part of your screen. We've got some questions coming in, but please, by all means, add in questions and we'll get to as many as we can. So one thing that I'd like to ask really of any of the panelists, some of you spoke about this, so you talked in sort of general terms about like success and sort of the goals of the administration, but I'm wondering if you can talk, and any of you, about like in really concrete and specific terms, the week after the COP, like what might you expect to see, or what would you hope to see? Like what would success look like? And, in terms of whether that's specific announcements from countries or it could be outside of government, as Rob is talking about.
Yeah, well, I could take a stab at that. Well, I framed it as substantial progress for a reason, towards keeping 1.5 alive, because I don't think you're going to have announcements that literally add up to 1.5 degrees. I think the climate action tracker at the moment, and I'm not sure if it's exact methodology, but I think at this point it thinks we're on track to something like 2.4 degrees, and you're probably not going to miraculously go from there to 1.5 in a couple months. But I think substantial progress might be a way to put it. And I think that's a combination of types of actions and also types of actors, right? So it's not just, and to Rob's point, it's not just governmental act. You're not just adding up NDCs. You're also looking at, commitments of various actors beyond just the traditional parties, and sort of creating some kind of inevitability, I guess, coming out of the COP, that the world is committed, even if it hasn't already done so, to keep 1.5 alive. And I think that in turn ends up, it's kind of mutually reinforcing in the sense that it sends a signal that the world is serious about that objective, and therefore helps, I think, make it happen by sending the signal that it is supposed to happen, the way these conferences often do. So I think that's, maybe that's a wishy-washy metric for success. I think you're asking the right question. I do often think about it's like, what's the headline the day after the COP? Is it quantitative? We are now on track to X degree limit, or is it more qualitative that you have a very wide range of actors committed to doing something? I think one thing Secretary Kerry has said, I might throw this in here, is that it's not just what everybody has committed to on the road to the COP and at the COP, but some kind of honest assessment at the COP of what else needs to be done. So some kind of plan for the decade. You could come up with some catchy title for that, and ideas are welcome. But the world sort of saying, here's what we've done so far, here's what realistically still needs to be done, and here's what we all plan to do about it. So I think that would go a long way to creating a successful COP. Thanks.
Great. So we got a question here about carbon markets, about Article 6 that Sue touched on in her talk. And I'd love it if you all can just talk about what role, well, the question specifically asks about what role the US will have in helping to broker an agreement on carbon markets. And I'd also be interested to hear just more broadly on the role that you see carbon markets playing, like both in the Paris process, but more broadly in addressing tackling emissions, because I think that at the same time as more companies and the private sector are talking more about this and clearly expecting to rely on markets to a degree, and governments as well, there's also more science and kind of scrutiny of carbon markets and their integrity and their ability to really guarantee that they are lowering emissions. So I'd love to just hear a little bit about that.
Well, I mean, when we're talking about carbon markets, you could be talking about a couple of different things. I mean, it's a market that a government has to structure, and so if you have issues like they had in Europe for a long period, where there were just too many carbon credits, you don't have the market doing what you want it to do, because the credits are, there's a surplus of credits, the prices are low, it doesn't really incentivize a change in behavior. So there's parts of the market where you're going to people may want to use mechanisms like that. Not everybody in the world structures carbon markets or carbon prices the same way. So you'll see situations like that. There's another issue, and I don't know if this you're also kind of embedded in what you're asking about, Nick, but I mean, there is this issue that is coming up with respect to offsets and how you evaluate offsets and how you calculate offsets. And I think this is going to be difficult on two levels, or things that people have to think about. I mean, one is, the offset structure itself is, here's what we think would happen, let's say, for example, to this piece of forest, these hectares of forest, under business as usual conditions. And so if you save them, you save X amount of carbon from going into the atmosphere. There's a lot of subjective judgments you have to make to come to that. And so there's always concern that there's opportunity for gaming that. But I think the other issue that comes up, and this comes up in the context of what's going on in the discussion between investors and companies that are talking about net zero today, and this shows the linkages really between maybe what could be a government discussion about offsets and then what is happening in the private sector as well, is that there are these plans that companies are putting forward that often assume quite a bit of offsets. Without necessarily asserting that the company's going to acquire them, but that they're going to be there. They might be embedded in the scenario. So they assume more emissions can be released because there's going to be some offsets in the future, but they haven't really figured out a way to pay for that. Or it could be part of the company's plan as well, and it may rely on that kind of sometimes potentially dubious accounting that I mentioned in the first instance. So I think there's a lot of issues to kind of work through there that are going to be complex, that'll go beyond the COP process.
So, and just to add to that, I'd say two things about carbon prices. I mean, first of all, most large companies are already affected by carbon prices to some extent. We have a lot of, cap and trade systems and state level in this country. Many companies that operate globally are affected by carbon prices. They're imposed by different kinds of policy regimes in other countries. But the overall average price is extremely low. So it doesn't, at least today, it doesn't really have a big impact on changing companies' behavior. And there's some limited circumstances in some states where that happens, but it's for the most part not affecting people. But the way that disclosure and accounting works is you're supposed to disclose, even under existing rules that has nothing to do with climate, you're supposed to disclose if the quality of your earnings. So if you say your earnings are X today, but because of some other factor, like years ago it was inflation in Brazil. I mean, and even before that it was inflation here, where the earnings that you're saying you have today are probably not going to be repeatable in future years because of this factor, right? Well, if carbon prices are going to increase because of policy initiatives being taken all around the world, and maybe on a global basis, maybe just every country is going to keep ratcheting theirs up, but that too needs to, even today, be taken into account in your disclosure about the quality of your earnings. And then also it affects your future cash flows. I mean, as you're thinking about what your future cash flows are, that feeds into evaluating your asset value, evaluating if your assets are impaired because costs are going to go up. You're not going to get the future cash flows you thought because now you're going to be paying a carbon price. Those are all estimates that exist in accounting already today. Those are the kinds of things that I mentioned earlier that, even under existing accounting standards, you have to worry about. And so the idea that carbon prices are going to go up because countries or globally, there'll be some kind of multilateral agreement to push a price of carbon up in order to change people's incentives, and companies will have to pay that price. That's already today got to be factored into accounting. So I think with the SEC saying they're going to be doing more enforcement, more review of this, going back to companies and asking them questions, I think you'll start seeing that come out even today more. And maybe more sensitivity analyses, what if kind of scenarios, but companies are going to have to disclose that more. Now, when it comes to offsets, that's a different, slightly different topic that Rob just raised, but that too is important because a lot of companies, they've announced these net zero or other kind of climate commitments. And if your commitment, your climate plan is based on buying offsets, like buying, preservation of trees somewhere, that today that's really cheap. It doesn't really show up on your income statement because the prices of doing so are really cheap. But if that's what makes your climate plan work, and so you can actually have emissions in other areas of your operations because you're paying for those trees, and then it turns out you can't do that because it's really not working, that the system on carbon offsets really wasn't reliable, then all of a sudden that's going to change your ability. If you stick with that commitment, which a lot of investors are holding companies to those commitments, it's going to change what you have to do. You may not be able to continue to use those high emitting assets in production if you can't actually make that. It's like the carbon offset is kind of like a plug that makes the calculation work. If that plug isn't there, the whole rest of the calculation falls apart. So you'll probably see that coming through in some corporate disclosure too, as this big conversation people are having about carbon offsets progresses.
Great. So, sorry, Sue.
Should I?
Yeah.
Well, I'd briefly just add, I think the question was whether the U.S. would play a brokering role, and I would just say, if past is prologue, the answer would definitely be yes, since that's kind of one of the tribal roles that the U.S. plays at these COPs, is to act as a broker. And some of the issues are quite complicated because when we were developing the clean development mechanism under the Kyoto Protocol, developing countries didn't have any commitments. So you didn't have any issue with respect to double counting, right? Because there was nothing to subtract from or add to. You didn't have any issues. There hadn't been, an agreement before that with targets under it, so you didn't have to figure out what was the relationship of the pre-existing agreement and system to the new one. Now there are all kinds of issues regarding, developing country NDCs, double counting, the transition between the CDM and this new version of a CDM, et cetera. So anyway, yeah, I do expect we will play a brokering role. Thanks.
Okay, so we've had a couple of different questions on something that we haven't really touched on much. Sue, this might be addressed to you, although not explicitly, anyone can jump in, but on the question of global equity, which I think is another of the kind of big issues that is at least hopefully that many want to be addressed in the upcoming COP. So this could mean, I mean, both for the Biden administration in the US and I think wealthy countries more broadly, like what is their responsibility towards developing nations to help them, and also what kind of support can the Biden administration or developing nations give to less wealthy nations to increase their own ambition and to meet their own emissions cutting targets?
Yeah, I think there are several different ways, excuse me, in which the international climate regime addresses equity, or you can think of it as fairness. One way is that the Paris Agreement, commitments on emissions takes the form of, as I said, nationally determined contributions. So you're not telling any country, or you're not sort of negotiating what each country has to do. Each country figures it out based on its own national circumstances. So that's I would say an equity feature, because you're not, developed countries are not going to developing countries and saying, here's what we expect you to do, and here's what you sign on the dotted line. So that's one. And the second is support in all different kinds of forms: financial support, capacity building support, and so on and so forth. At this particular COP, although not explicitly on the agenda, I expect, and particularly like in the run-up to the COP, that a lot of donor countries will be increasing their financial assistance. President Biden made an announcement during this Earth Day summit about U.S. Plans to increase assistance for both mitigation and adaptation. And then something that's actually explicitly on the agenda of the COP is setting the new mobilization goal post-2025. You may remember that starting in Copenhagen, developed countries agreed to mobilize $100 billion a year for the benefit of developing countries. It's a collective goal. And that was set to expire in 2020. In Paris, it was extended as kind of part of the overall Paris package to 2025. And then this year, the parties are supposed to start the discussion on like what happens post 2025. And that will raise all kinds of interesting issues about, who should be part of the donor pool, who, how much, for whom, for what. All of those elements will be part of the discussion. Now, that doesn't need to be decided this year. It just needs to be decided before the existing goal runs out in 2025. But that sort of explicitly addresses, the question you asked about support for developing countries.
Great. Anyone else want to quickly jump in before I move on? Okay. Well, unfortunately, we are pretty much out of time here. So I'd like to thank the panelists, and thanks everyone for joining this webinar. And Carbon Tracker will have another pre-COP webinar coming up on May 27th that will look specifically at Nigeria, so we can get into some of these questions a lot more. So I'm sorry we didn't have time to get to more questions, but thanks again for joining everyone. And hopefully we'll see people back in later in May.